Good afternoon. My name is Laura Brancato. I'm a senior attorney with the law firm of Littman Krooks. Thank you all for joining us today for our Lunch and Learn presentation about estate planning and insurance. Just a reminder, I know you might have all just clicked acknowledge, but this is being recorded so that you can refer to it in the future. If you look in the chat link, you will see the link for our Lunch with Littman Krooks webpage where you can find this and other Lunch with Littman Krooks recordings. So my guest today is Evan Ross, financial representative at the Ross Company, and we're going to have a conversation today about how estate planning fits into your, how insurance products fit into your estate planning and the different mechanisms you can use to plan for long-term care. So as many of you know, here at Littman Krooks, we specialize in estate planning and elder law issues. And one of the top priorities for our clients always centers around how to pay for care when you become older, if you need assistance at home or outside of your home. And how that fits into your overall estate plan is a really important part of discussion with a certified elder law attorney and with a licensed insurance professional. So today I'm happy to have Evan here to walk us through how insurance fits into a good and well-reasoned estate plan and how you can protect against the rising costs of long-term care. So Evan, can you tell us a little about yourself and the Ross Company?
Sure. Thanks, Laura. So the Ross Company, here we provide creative insurance solutions to help our clients protect their assets, protect their wealth, and reach their financial goals. We are independent insurance brokers. We work with every insurance company so that we can really best fit solutions to our clients. We're not beholden to one over another. It's really about what works best. We have a needs-based approach, and in determining your needs, that'll help us figure out which insurance carrier to go to. In our insurance planning, we don't charge any fees. If there's any work to be done, we get paid by the insurance company, so we can really focus on your goals and your needs, and no one's thinking about, what is this costing us? We like to focus on we really focus on our clients, and so that's us.
Great. So Evan, let's start the discussion, as I mentioned at the top, with the issue of long-term care. Can you start out by telling our listeners who should be considering long-term care insurance and when should they be considering it?
Sure. So with the majority of our clients, we don't necessarily start having a long-term care conversation until they're in their mid-50s or so. Before that, to start thinking about long-term care and start paying for it so early on, chances are you'll be paying for a long period of time. So although costs do increase as you get older, we tend to kind of wait until the mid-50s. Now, that has changed a little bit over the past couple of years as long-term care solutions have widened, I guess you could say. There are ways, more inexpensive ways for younger people to start thinking about it and locking in costs at a younger age. But that's about, when you get to be between 50 and 60 to really start focusing, that seems to be kind of the main area.
Okay, great. So can you give us a broad overview of what is a long-term care policy? Are there more than one kind? And how does a person go about qualifying for long-term care insurance?
Sure. So what long-term care does is provide liquidity to pay for your care, for in-home care, for nursing home care, for assisted living facility care, so that you don't necessarily have to be spending down your own assets. You get to protect those, and the insurance company will pay those bills up to a point. To qualify for long-term care, one must not be able to perform 2 out of the 6 activities of daily living: bathing, dressing, feeding, transferring continence, and toileting oneself. This also includes dementia and Alzheimer's. So as if you get to a point where your physician says you cannot perform 2 out of the 6 of these, you would qualify for your care if you have it. Now, there's various types of long-term care insurance. There's a traditional policy, which after a waiting period, the insurance company will start to pay your bills. And these policies, while they are comprehensive and great, have kind of fallen aside a little bit over the years. Over the past 10 plus years, people have started really using this care more and more. And the insurance companies started to realize that they have to pay out the benefits. And a lot of the insurance companies got out of the business. A lot of them keep repricing their products so that the cost to you as a consumer keeps increasing. And so they are good policies, yet the industry had to look at them and say, well, what can we do different or better? One of the ideas that the insurance industry came out with is a combination long-term care with life insurance, so that you can keep a level premium. They cannot come back to you and say, we're going to increase the costs. And you're not paying for something that you may never use. At some point, whether you use the care or, if you don't use the care and you pass, then someone will benefit from what you're paying for. So it's been a nice alternative or even complement to the traditional long-term care policies. Some of the benefits of the traditional policies is that they can increase over time. So you can start out with a smaller benefit. And as you age, the benefit will increase, as inevitably you're going to need more care 10, 20 years from now than you will today, or the care will cost more. And you can really tailor these policies to your needs. There are many different riders and facets to the policy that you can really, make them your own. The life with long-term care insurance, as I said, some benefits are level premiums, along with, the fact that it won't be a use it or lose it type of thing. Someone will benefit from these. But one of the things that these policies allow for, which the traditional used to, and really not many do anymore, is an indemnity long-term care feature, where instead of just saying, this is my bill, please cover it, you will get whatever you're entitled to. So if you're entitled to $10,000 a month of benefit, regardless of if you have a bill of $5,000 a month for your care, you will get your full benefit to use as you please. So it's a little more flexible and almost a little more consumer friendly than some of the traditional policies.
Great. You mentioned something, Evan, that I think is important for us to touch on here. You mentioned that long-term care insurance in either model that you discussed could cover care at home or care in a facility. And you also mentioned that it could cover care in an assisted living facility. And I think it's important for our listeners to understand that more typically our clients are accessing either care at home, or in these new continuing care models or assisted living models, memory care, et cetera, are really more frequently now accessing the assisted living model of care. And many of our clients here at the firm come in with questions about Medicaid planning. And they come in with questions about how to structure their assets or use trust vehicles in order to assure that they could qualify for Medicaid. What's important to know is that Medicaid coverage, even if it is obtained, will never cover the cost of an assisted living facility, or very rarely would. And even if they did, the quality of the assisted living residence would probably not meet with what the client desires or to live out their life. So if a person is thinking about one of these types of living arrangements, like an Atria or a Bristol or a Sunrise facility, or many of these other, I'm just going to ask everyone to stay muted so that we don't get the echo. Thank you. If you're looking to access that level of care, a long-term care policy or private payment really will be one of the only two options for affordability reasons. And at the current time, we're finding that the average cost of that type of care is running from anywhere from $7,000 to $10,000 a month. So planning against or for that eventuality is a really important part of an estate plan. So thank you, Evan, for for bringing that out. Can you tell our clients more about how a person goes about getting one of these policies, what is involved in getting a policy, and how the prices are structured, just a general idea?
Sure. And if before I get to that, if you don't mind, I just want to jump back. You mentioned that a lot of your clients really focus on either the assisted living or in-home. And I had mentioned that a lot of these policies have a waiting period. And once you're eligible for care, there's a period of time before the insurance company will start paying. Well, one nice feature to some of these policies is that they will waive that waiting period for in-home care. And I know a lot of people do prefer, if possible, to get in-home care. So it's nice to not necessarily have to wait for that. So I just wanted to add that in from before.
Thank you.
As far as so to obtain a long-term care policy, it's similar to life insurance or disability insurance, where you submit an application to the insurance company. Nothing is binding. They review the application. There's usually a phone interview, a potential in-person interview, and depending on what comes up or what the underwriter sees, there might be an in-person exam. Not always. Once all that information is collected, sent to the insurance company, the underwriter reviews it. They come back to us with an offer. And again, still nothing binding. At that point, we can choose to accept it. Or if we don't like the offer, we can choose to go to one of the other carriers and see if someone will give us something better. The process can take, depending, I would say anywhere between 4 to 8 weeks. It is a little bit of a process, not much that you as a client would have to do, but it is a process for the underwriter to review everything. And then once you have the policy, from day one, once you make that first payment, it is in force. If you needed care the next day, you are covered. As far as pricing goes, it's really determined by the benefits that you're choosing to get. So it could be by the monthly benefit that you're looking for. It could be by the overall pool of money that you're looking at. It could be how much you want your benefit to increase every month or every year rather, until you need care. So we can kind of adjust policies to best fit your budget. That being said, it also has to do with your age and your health. So as long as you are healthy, and depending on if you're not, depending on when and to the level of what your medical history is, you can really, I'm sorry, that's what's going to determine the cost. So as I mentioned at the beginning of this, we usually look around age 55 or so to start. As you get older, it does get more expensive, but it also doesn't make sense to pay for years and years when at 35 years old, when you may not use the care for 40 years. So we have to figure out the kind of the fine line between it all and what suits you best.
Absolutely. So Evan, as we here at Littman Krooks in our estate planning department, as we look at a client's estate and what their goals are for the future, certainly paying for long-term care and planning for that is one of our main objectives. But we also advise clients about the ways to handle what might be expenses or taxes after death. And we talk often about the use of not just long-term care policies, but other types of policies, predominantly life insurance. So I'd like to transition a little bit in the discussion about, I see someone may have a question. If you have a question, you can type it into the chat box and we can answer it at the end. So I think you're muted, sir. So Evan, can we transition?
I have a question that's very appropriate. I'd like to ask it now if I can, please.
Sure.
And it's about long-term health care, which I'm interested in buying for my wife. She's 73 and a half. I myself have a John Hancock policy for many years, soup to nuts. I don't know much about this, but I understand there's something called a hybrid long-term healthcare policy. So my question is, and I'm going to ask you to give me generic responses because I don't expect you to have this specifically. Could you give me an idea, what would a policy run for somebody, and I'll just say it this way for time's sake, who's got a fairly good benefit situation at, let's say this would start at the age of 74 for Rachel. How much would this amount to, how much would that cost us through your group, whatever group that you would do this through? Can you give me a little idea of what a hybrid policy works? Is it, and what would it run us and how does that work?
Sure, Jeff. So it's very hard for me to just give you a cost because it's not just based upon age. You know, I can ask you, well, how much of a monthly benefit do you want? So we can get into a little more specifics, but just to give you a general idea, what these hybrid policies are both long-term care and life insurance. So for argument's sake, let's say you have a $500,000 life insurance policy. Well, essentially you have a $500,000 pool of money to use for long-term care. The insurance company says, and we know this ahead of time, we determine, you know, let's say you're going to get $10,000 a month of benefit. Well, we know that is the benefit. The pool is 500. That does not go up. That is what, that's the benefit. That's what it is. If care is used, great. And then upon the insured's passing, anything remaining will be passed along to their beneficiaries tax-free. If care is never used, that full $500,000 will be passed along to their beneficiaries tax-free. So that's kind of a general overview as to how the policies work. There are some variations to those. But to give you a price, I'd be happy to. I would need a little bit more information.
So we'll talk, I trust. My last question on this is to say the benefit in today's dollars was $6,500 a month. With a good policy, should Rachel need that? With a $500,000 death benefit, approximately how much would that cost us a year to fund that hybrid long-term healthcare policy?
Sure. And that's,
You can answer that, Evan, yeah.
I don't want to give you a wrong information. And I just, 507.
I guess we'll
You
take
know
an
what?
estimated guess, Evan.
Yeah, I mean, I can give you a range of somewhere between $12,000 to $18,000 a year. Maybe, could be less, it could be more.
Right,
Again, there are ways to structure these policies to decrease and increase, but that's a general idea.
okay, great. Thank you, Evan.
Sure.
So, thank you, Jeff. So heading back over briefly to this conversation about the use of life insurance and how that plays into estate planning. Do you do that kind of evaluation when you meet with your clients? Not just that life insurance covers, let's say, the cost of their mortgage to make sure that their family would be sustained, but are there other uses of life insurance policies that we think about when we talk about estate planning more broadly?
There are, Laura. You know, life insurance, and it would be important for you and I to work closely together with the client to determine, you know, their estate tax needs. But life insurance can be used, like you said, to cover a mortgage. It could be used to cover taxes that might come up upon death. It could be used to transfer wealth. You know, a lot of times people will decide, you know, insurance is great, but it's not always what everyone needs. And maybe someone chooses to fund their care or just to live and spend down their assets. Well, that's all well and good, but if their intention was to also pass those along to their heirs or to a charity or to whoever that might be, life insurance can do that. It can provide that liquidity so that you can either protect yours or spend yours and still transfer the wealth that you had hoped to.
Thank you. Now, can you tell our listeners if a person on this call is already holding a life insurance policy, Could that be converted into the type of hybrid policy we spoke about a few minutes ago, or do they have to start the process from the beginning?
Sure. So the answer is yes to kind of both of those. The process does need to start again, yet many times you might be able to, as long as you're still healthy, you might be able to utilize your current policy, depending on what type of policy it is, to help offset some of the costs of a new, more comprehensive policy that better fits your needs. And that's one of the things that we can do is analyze if that makes any sense, and determine, does it make sense to just stay with what you have, or is there something different, better out there that would better suit your needs?
Great. We often encounter clients, Evan, during our estate planning consultations who may have bought policies many years prior to their first contact with our office or with any estate planning attorney. And they may be paying premiums on policies that either no longer suit their needs or may not really be necessary anymore. What do you recommend for listeners who hold life insurance? How frequently, or any kind of insurance really, how frequently should they be checking in on those policies, and what can you or similarly situated professionals do to assist clients in looking at the products that they may already own?
It's a great question, Laura. Thanks. So I really recommend that you review your life insurance, whether it's a simple review or a more in-depth review, every 3 to 5 years. We notice that our clients end up having some sort of changes in their life, big or small, every 3 to 5 years. And we think it's important to review the policies to make sure that they continue to fit your needs, whether your needs become less or more. It's important to not pay for something that you don't need, or to make sure that what you are paying for is proper. So I think it's important to review every few years. And if all of a sudden someone doesn't need life insurance anymore, but they've been paying for it for such a long time, there are avenues that we can take to compensate someone for that. Basically, you're able to sell your life insurance policy if it made sense, and vice versa. If you don't have enough, well, it's important that we review and make sure, whatever your need is covered, because the last thing you would want, or I would want, and the reason that you took out the policy is to protect someone or something. So to not have enough protection is a detriment. Right.
We would agree that from the estate planning side, being underinsured or sometimes being overinsured doesn't necessarily fit in with the greater plan. The way we generally see it is we have individuals who have retired and are on fixed income, whether that's Social Security income, pension, required minimum distributions, or a combination of many of those things. And they might be spending a significant amount of their monthly income on insurance premiums. And we're often asking the question, is this still a viable use of retirement funds? Is this something that prevents you from doing things that you enjoy? Is the policy no longer something you bought 30 years ago to cover your mortgage, which has now been paid off for 10 years? Is this still something that needs to be managed? And I think it's an important point you raise, Evan, that a client should not simply just stop paying the policy. There may be options on free market where the policy might have a monetary value which they can capitalize upon. So I think that's a really important point to bring up for the listeners here today.
And Laura, just to add on that a little bit, many times people also have these policies they've been paying for years, and there might be cash value to them. And there's a chance they have been underperforming, and it's important that they're reviewed to make sure that more money isn't owed to the insurance company, and vice versa. Maybe they've been performing really well, and someone says, I still need this insurance, but I don't want to pay for it anymore. Well, these policies are flexible, and many times you don't even necessarily need a new policy. Maybe it can pay for itself. There's a lot of options when it comes to these, and that's one of the reasons it's important to continue to review them every few years.
Right. And I think the overarching message for our listeners is that when a client comes in for estate planning, even just considering how the premiums fit into the overall retirement plan is a really important part of the decision making of how to be insured and which products are appropriate. Some of our clients have a very large income stream upon retirement, and some don't. And understanding how to best utilize that income is a really important piece of the puzzle, especially in as the generation that's retiring now may have less in savings and less Social Security benefit than those that have retired before them. So having access to income and using income appropriately is a really important part of the overall discussion. I see that we have one question in the chat. At this point, if anybody has a question that they would like Evan or I to answer, you can put it into the chat. Evan, I'll read the question that's here now, and maybe you'll be able to answer this. I'm 59 and a half and own an inherited traditional IRA for which I am taking annual required minimum distributions through an annuity. Can I transfer the IRA into a hybrid long-term care policy or into a whole life policy and still meet my required minimum distribution requirements?
So that's a great question. There may be a carrier that will allow you to, I need to check on this for sure. There might be a carrier that will allow you to transfer the entire account to pay for long-term care. It would also be life insurance, and it would satisfy your distributions. But what we find more so is that someone will use those distributions since you have to take them anyway. And if you don't need that money every year, you can use that to fund a separate policy.
Right. Great. Thank you. So I just want to talk for one moment about a topic that you and I talked about offline, which is what happens in the unlikely event, though I'm sure it happens, that a person who wants to purchase long-term care insurance, for example, or one of the hybrid life insurance policies, what does a person do if they can't qualify, if they're uninsurable, or if the premiums are so high that they're not affordable? Are there options for those types of situations?
Sure. So there may be options. Whenever we do these reviews of your overall financial plan and your insurance, if for some reason you are uninsurable or the costs are too high, if you have, depending on where your assets are, there may be ways to reposition your assets or reposition your plan, your financial plan, so that you almost earmark in a safe manner money to be used for your care. And the good news about that is there are no insurance costs. You are using your own money, and just like life insurance, if you do not use it for care, you can use it for anything else or to pass along to your heirs. So it's going to be on a case-by-case basis, but many times there are ways to reposition what you've already created for yourself to even if it's just to cover a portion of your care, to cover something that maybe that helps. And you could speak to that, Laura. Maybe it helps in addition to Medicaid, depending on how it's how it's set up. But I think that there can be other ways besides just insurance.
For sure. And I think what I would add there is any good estate planning attorney would be really looking at the client's whole financial picture to determine, and also maybe, a diagnosis that they may have. They may know early on that they have a progressive or degenerative illness that we know care will be required, let's say on 5 to 7 year timeline. And we could really look at what maybe Medicaid, qualifying for Medicaid is the best option for a client who can't be insured. Because just as a brief touch on this briefly, and you can always find more information about Medicaid on our website or on our YouTube channel. We do a lot of different lunch and learns and webinar and Zoom formats on this topic. But for clients who cannot or do not obtain private long-term care insurance, Medicaid is a government benefit program run through New York State and funded in part by the federal government, which can provide insurance benefits in a sense for seniors 65 and over who need care, and in certain circumstances for people younger than that. But those benefits could be provided either at home or in a nursing facility. As I mentioned at the beginning of the program, in terms of flexibility, certainly using a government entitlement program is always going to be less flexible than having a private policy. And so we encourage our clients who can consider insurance to do so, because it gives you the freedom to really determine what care fits you best, not just what Medicaid is willing to pay for. Certainly, Medicaid benefits at the nursing home level are generous and comprehensive. And for individuals who need to be cared for in a skilled facility, Medicaid is an optimal choice many times. But we do have plenty of nursing and skilled facilities that do not accept Medicaid, at which point, if you wanted to be cared for in some of those facilities, you would need a mechanism of paying privately. And the only other mechanism for payment other than your own personal savings account would be something like a long-term care policy or life insurance with a pull-down benefit. So these are all important considerations. And I agree with Evan that though you may not purchase the insurance until your mid-50s, having the discussion about what the plan is can happen at any point. So I don't see any further questions at this point. Evan, anything else you wanted to add?
No, just to reiterate what you said, it's, these policies provide you flexibility and really control. It allows you to make a lot of the decisions for your care as opposed to them being made for you. So I think that, if nothing else, you should be having conversations about, do I need this and is it affordable? And if not, so be it. But at least you have the conversation and you're not just wondering what's out there.
Right. I would also say as a, as an aside, that the role and the model of care continues to evolve over time. And we see that here on the elder law side, when clients come in for Medicaid consultation or consultation about long-term care, the market is consistently changing. So whereas 10 years ago, this model of memory care, as we know it now, or reminiscence care, it's often called, wasn't really predominant in the market. Now, to meet the demand of the increasing number of individuals diagnosed with cognitive impairment, we see many, many facilities that are opening that are only memory care, really only focused on a certain type of care. And that model of care continues to evolve and include even things like continuing care communities, which are becoming also exceedingly popular. And understanding where you think you want to go is a really important part of the discussion of how do you pay for it. Meeting with myself or with Evan before you really have any vague idea of where you want to be, sometimes it's challenging to understand what benefit you'd be looking for. So I know sometimes it seems counterintuitive to think about these things in your 50s, or even earlier, but it's certainly important. Through our newsletter, we're constantly updating our clients about new innovations in care and about changes in law. For example, we had a recent change in the Medicaid law, which is significant for our clients in New York who want to access home care. So it's important also to stay in the mix in terms of the updates in these areas, because the laws are changing frequently to meet with the demand and the rising care of costs, the rising cost of care for certain. There's a question here. Here we go. So this is a follow-up to the question you answered earlier, Evan. If I apply annual RMDs to fund monthly premiums on a policy, do I get a tax deduction for my New York State tax return?
So I need to preface this by saying the last thing I'm going to give here is tax advice. I am not a tax advisor, and I will not be held to any tax advice here. But in the past, and I'm not sure if it's still current, we need to check on that. In the past, your premiums for long-term care were able to be combined with your other medical expenses. And if they met a certain percentage of your income for the year, you were able to take some sort of deduction. That's about as general as I can speak on it. I don't know if it is still the case, but we can easily look in, we can speak with some other tax advisors, and we can look into that in more detail for you.
Great. And Evan, in addition to someone like an estate planning attorney, is there any other type of professional that you work with in this space to help clients understand how to approach these questions?
Yeah, I think, between myself, you, Laura, and estate planning attorney, as well as your accountant, the three of us together everyone needs to be on the same page. and everyone's looking at different areas of your life. So I would say that that's a good trio of advisors to keep around you when having these discussions.
Great. I know we have a few minutes. I'm wondering briefly, you and I had a discussion about disability insurance. And I'm wondering if briefly, I often get this question from my clients when they ask me, is the policy that I carry through my job for either short-term or long-term disability, is that comprehensive enough for me? Or should I be considering picking up an outside disability policy? I'm wondering if that's something you could speak to.
Sure. So I think disability insurance is extremely important, especially for, I would say, people ages, maybe before you start thinking about long-term care potentially, but between ages 20 and 55 to 60, I think disability is very important. The likelihood of us becoming disabled and not being able to work is much higher than us dying at those ages. So it's very important. And depending on what you do for a living, there's a chance that your work policy is sufficient. It could have the proper definitions, it could be the proper benefit, but the only way to know is to have that conversation. And sometimes HR is the one to have it with, but many times not. It's important to speak with an insurance professional and say, okay, this is my monthly need. Does my policy cover me? And we can review the benefits of your current policy and see if it does. One thing to keep in mind about a policy that you have at work is if you leave that job for whatever reason, many times it is not portable. You cannot take that policy with you. So then you hope that the next job provides you a similar benefit, but you never know. If you have a personal disability policy, it is portable. Obviously, it's yours all the time. And so it's a little more flexible. And with a work policy, that is if depending on who pays for it, determines the taxability of it. It also, many times these group policies can be offset by Social Security disability if you were to receive that, whereas a personal policy will not. So there are benefits to both, and it's important to look at both of them when discussing what your needs are.
Great. It sounds like another area where the licensed insurance professional really could give you the broader picture to ask yourself the questions that you as an individual may not have even thought to ask. So
Agreed.
Thank you for shedding light on that topic. We don't often have the discussion about disability insurance until a person unfortunately has already become disabled. And then we usually encounter it in the scenario where it's not enough to cover monthly expenses and we're trying to do other planning or figure out another mechanism for paying for care. So that's a really important point to touch on.
And your ability to earn an income is your biggest asset. A lot of people think their biggest asset is their house or their 401k, or your ability to earn an income is your biggest asset, because if that goes away, how do you live? How do you take care of your family? So it's important to make sure that if you could not work, you still have that income and you can still live.
There's a question that just came in from Melanie, and it said, Evan, did you say a good trio is elder care lawyer, estate planner, and insurance? I think you said, yeah.
No, go ahead.
No, go ahead. You can say.
So elder care and estate planning attorney, I know that while they're not identical, many times they, or at least in their office, will cover a lot of the same issues. So you want your estate and elder care attorney, your accountant, and your insurance professional, your financial advisor.
Wonderful. Okay, great. So if there are no further questions, on behalf of everybody here at Littman Krooks, we thank you for joining us. And Evan, thank you for being our guest today on our Tuesday Lunch and Learn series. Evan, would you put your information in the chat feature, your email, in case of any of our listeners have additional questions?
Yes, I will.
Want to reach you? Okay, great. And as I mentioned at the top of the program, this recording will be available on the link that was provided there in the chat if you need to re-listen or recall anything that we've said. But certainly these are issues that can be somewhat complex, and the sooner you address them, the better. Time is always a benefit. Planning for these types of occurrences, either at the last minute or in an emergency, usually means that we can't maximize the use of any of these planning mechanisms for our clients. So we always hope that people come to us as early as possible, come to someone like Evan as early as possible, so that we can maximize what's available for each and every client who comes our way. So thank you for being our guest today, Evan.
Thank you very much, Laura.
Have a good week, everybody.
Take care, everyone. Thanks.